Well, greetings to our High Rock clients and any other listeners on this sunny but chilly Tuesday afternoon in Toronto. And thanks for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategy. So sit back and relax and perhaps grab a glass of wine, unless, of course, you have resolved not to drink in January. Now, we are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and my partner and colleague, Paul Tepsich, is also on the call. He's the founder of High Rock, and as well, we have our financial planner, Bianca Tomlinson, with us. We'll have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. Well, Happy New Year to everyone. There is lots to talk about today, so I'm going to get right to it. Over the course of 2015, we compiled a list of themes that we thought we should guide our investing thesis. Many of the predictions made by analysts, economists, and the media, and even central bankers at the beginning of the year, failed to come to fruition. Oil prices and commodity prices continued to tumble over the course of the year, dragging inflation significantly lower. Volatility causes uncertainty and in turn causes economic decisions to be postponed. Central bankers do not want this as it slows economic growth. Now, most central banks continue to ease monetary policy to help stimulate their economies and keep that volatility at bay. This appeared to work until late August, but overpriced assets, especially in equity and high-yield bond markets, could not hold their highs. Many had expected that 4% plus growth for the U.S. economy in the second half of the year would help pull the global economy out of its malaise. However, despite U.S. domestic demand for automobiles with cheap financing and more dining out at restaurants, the global economic drag from China and emerging markets was a big anchor that held the U.S. economy in check. It was widely expected that the stronger U.S. economy would set the U.S. Fed to raising interest rates in June or September, but this was eventually pushed back to December. We worried about deflation through 2015, and in fact, we are still worrying about it now. Bond markets gave us a hint of volatility in July. Equity markets followed in August. Overpriced equity markets peaked in May, but despite some move to better values in August, lower interest rates inspired buyers to continue to pay too much for risk assets. Slow economic growth, declining corporate revenues and earnings, low inflation, and low interest rates kept 2015 as a year of low returns. In fact, Bloomberg suggested that it was the year that nothing worked. So let's have a closer look. Our benchmark All Country World Index ETF had a negative total return of minus 2.2%. Now that's the aggregate change in price of all the constituent companies plus any dividends that were paid. The Canadian Bond Index ETF returned 3.26% over the year. Now, 60% ACWI, All Country World Index, and 40% XBB, which is the Canadian Bond Index ETF, that portfolio would have had a break-even return this year, not allowing for any change in the value of the U.S. dollar. Now, 40% ACWI and 60% XBB portfolio would have returned a little over 1%. Comparatively, the TSX had a negative return. The S&P 500 was slightly positive. Europe, Australia, and the Far East slightly negative. Emerging markets were the largest loser, and the U.S. dollar was the biggest winner. So a hedged emerging market allocation back to Canadian dollars was actually flat over the course of the year. Certainly any US dollar holdings would have benefited when converted back to a Canadian dollar equivalent. But it's not just about one-year returns. If we look at the long-term averages, you can see how everything actually smooths itself out over time. Perhaps some of you tuned in to BNN's The Close on Fed Decision Day on December 16th to see me suggest a slightly overweight position in the underperforming Canadian equities and Euro area equities, and an underweight holding of expensive US equities, what we would call classic rebalancing. Well, the natural question, next question is how did our models fare in 2015? Well, unfortunately, we did not really begin building our models until mid-May, after a month of very in-depth research on the appropriate ETFs and some of the other securities that we wanted to own. And only gradually did we begin to adjust client portfolios, so that it would be misleading to suggest that client portfolios had the full benefit of a year of these models. However, if we extrapolate our fixed income holdings back to the end of December of 2014, a fully invested equivalent of our model would have returned a little over 4.25%. Now compare that to the Canadian bond index return of about 3.25%, or slightly better. Now our global equity model would have returned approximately 11.75 in Canadian dollar terms with our hedged ETFs and US dollar holdings. Our tactical equity model actually had a small negative return of about 0.5% since its inception in May, but comparatively, the Canadian small cap index had a total return of a negative 17.5% since May, and in fact, an annual total return of minus 25.2%. So I think Paul did an extremely good job of managing that tactical equity to a basically unchanged situation given the circumstances. So congratulations, Paul, on some pretty good picks along the way there. Now, a portfolio of 60% equity, and for example, 50% of that in our global equity model and 10% in our tactical model, and then 40% fixed income would have returned approximately a 7.5% return. Now, again, I stress that this is hypothetical based on the assumptions of extrapolating data for the full year, assuming the portfolio is fully invested in our models. The point here is that we are certainly on the right track with our models, and that our hypothetical 60-40 portfolio was nicely ahead of our benchmark. However, as we look beyond simple one-year returns in the long-run management of our clients' strategies, this is but one aspect of the work that we do for our clients to earn our fees. Our ongoing client wealth forecasts contain the keys to portfolio strategy and structure, tax efficiency, and retirement and estate planning with a long-term focus. Okay, let's look at the current state of equity markets. As we had said for most of last year, we felt that they were expensive relative to the valuations and earnings metrics and other leading indicators that concerned us that have historically foretold of the potential for equity market declines. Now, a downtrend began last May in our All-Country World Index, culminating in a significant sell-off and a huge spike in volatility in August. However, continued low interest rates and global monetary stimulus from central banks have encouraged investors to buy overvalued equities, and there was a bounce back in the August to November period, making equities expensive once again. However, from a short-term technical perspective, the inability of enough buying to end the downtrend toward the end of the year has brought renewed selling pressure to the start of this year. And buying support has not been enough to provide support to the market at current levels. This means that there may likely be a test of support at lower prices at the September and August lows. We are looking at those levels as possible buying opportunities, but remain cautious to wait for further developments on the revenue and earnings fundamentals. Volatility remains at its longer-term averages since the spike last August. We think this theme will continue for much of 2016. Oil continues to test its 2008 lows near $35. The Bloomberg Commodity Index has also been testing its multi-year lows. And as a result, the Canadian dollar is testing multi-year lows as well, hitting the key 1.4 level today and at the end of last year. Well, the World Equity Index that we follow is comprised of about 52% of U.S. companies, so we keep a close eye on what is happening in the U.S. economy. A day after our last webinar, and as expected, the U.S. Federal Reserve raised interest rates, citing that they saw improving economic conditions and expected inflation to move towards their 2% target level, and that the future increases were to be gradual, and that is how they left things. However, when we look at how Federal Reserve governors have forecasted their expectations, we see on average 4 increases in the federal funds rate in 2016. So as it's known, the dot plot of their expectations tells us that perhaps they're not looking at such a gradual move. Well, this week we will see how the trend in employment evolved in December. The trend had been or has been declining. The most recent jobless claims data showed a spike higher, and the 4-week moving average has been trending higher as well for the last few weeks. The latest data on manufacturing has showed a continued contraction, enough to significantly slow the fourth quarter GDP growth expectations from near 2% the last time we talked in mid-December to just 0.7%. Now this, at the moment, does not look as optimistic as the Fed has suggested it might be. It remains to be seen how this will impact 2016, but it is hardly impressive at this point in time as we begin the new year. Around the rest of the world, Euro area companies represent about 16% of the world equity index. So the European Central Bank eased monetary policy back on December 3rd, but it was less stimulative than the market had expected. After some volatility on the following day, European Central Bank President Draghi said, "I can say therefore with confidence and without any complacency that we will secure the return of inflation to 2% without undue delay, because we are currently deploying tools that we believe will achieve this, and because we can, in any case, deploy our tools further if that proves necessary." Well, subsequent to that, yesterday we saw core inflation in the euro area, which excludes prices of energy, food, alcohol, and tobacco. Well, they remained at 0.9% in December, and excluding energy, the inflation rate slowed for the second month to 0.9% from 1%. This continues to be well below the ECB target. So we wait to see how inflation will progress after the central bank, European Central Bank stimulus. Well, Japanese companies represent 8% of the world equity index. The Bank of Japan kept its pledge to increase the monetary base at an annual rate of 80 trillion yen at its December meeting, but it said it would extend the average maturity of government bonds it purchases from 7 to 10 years to 7 to 12 years, so a little bit longer maturities, buying a little bit longer maturities. Policymakers also established a new program of buying exchange-traded funds at an annual pace of about 300 billion yen, in addition to the current program of around 3 trillion yen. This will begin in April of 2016. Well, in Japan, the core inflation rate increased 0.1% in November over the same month in the previous year, the first increase in 5 months, but again, remains well below target, as do many other inflation rates. Companies in the UK represent 7% of it. As far as the Bank of England monetary policy, their committee voted by a majority of 8 to 1 to maintain the bank rate at 0.5% and unanimously leave the stock of purchased assets at £375 billion at its December meeting. This was widely expected, and policymakers continue to show concerns over slow wage growth in the UK. Core inflation in the UK increased 1.2% in November over the same month in the previous year, but remains well below target. Well, Chinese companies represent 2.5% of the world equity index. China's central bank injected 130 billion yuan, or 19.9 billion US dollars, into the financial system via repo agreements at an interest rate of 2.25% this morning. It is the biggest cash injection since September, aiming to calm markets. The move comes after the Chinese stock slumped nearly 7% yesterday after data showed the country's manufacturing sector shrank for the 10th straight month, leading to a global sell-off. The manufacturing data in China dropped to 48.2% in December from 48.6% in November, and below market expectations. While the reading was the lowest in 3 months, factory activity has been in a contraction since last March. Production declined for the 7th time in the past 8 months, driven in part by a further fall in total new work. Client demand was weak both at home and abroad, with new export business falling for the first time in 3 months. Manufacturers continued to trim their staff numbers and reduce their purchasing activity in line with lower production requirements. Meanwhile, deflationary pressures persisted, as highlighted by further market marked declines in both input costs and selling prices. So some concern over the direction of the Chinese economy, especially in the manufacturing sector. In Canada, where companies represent 3% of the world index, the Bank of Canada did leave its benchmark overnight rate at 0.5% at the December meeting, saying that inflation risks remain balanced while the economy continues to undergo a complex and lengthy adjustment to the decline in terms of trade. The bank rate is correspondingly 0.75%, and the deposit rate is 0.25%. Core inflation rate in Canada increased 2% in November over the same month the previous year. And this is the lowest since July of 2014. Real gross domestic product was unchanged in October. It's a few months back after falling 0.5% in September. Gains in mining, quarrying, and oil and gas extraction, as well as the public sector, are offset by declines in manufacturing, utilities, and retail trade. But it does not bode well as the first indicator for the fourth quarter numbers for GDP. So we'll keep an eye on those for the Canadian economy. Okay, what do we see on the horizon? Well, let's go to the bond markets because they tend to lead other financial markets. Let's check in there. Canadian and U.S. 10-year yield spreads have widened to an 85 basis point spread, as it is expected, with that U.S. rates will likely rise over the course of the next year, and Canadian rates will likely remain as they are, or possibly be lowered by the Bank of Canada as the two economies continue to diverge. In the U.S., short-term yields have adjusted to expectations of further Fed rate hikes, but the longer-dated maturities remain little changed. Now, the Canadian yield curve has flattened as economic data continues to show little growth. The German yield curve shows the possibility of future European Central Bank easing of monetary policy in the shorter maturities, with yields now at a negative 0.5%. The steeper curve at the longer end suggests some potential for economic improvement. And there's little change in Japan, where they are economically stalled at the moment. Well, historically, high-yield bond markets lead equity markets. Now, we followed this regularly over the last few months. The gap between the two has narrowed slightly, but remains relatively wide, suggesting that equity markets could potentially fall further. Well, equity market prices have cheapened up a little bit to begin the year, but we still think they have room to fall further. Analysts project revenues and earnings to increase over the course of 2016, and that this will help increase spending as companies replace aging equipment and take advantage of tax incentives. So that anticipated to be somewhat of a positive sign for the U.S. economy. We'll keep an eye on these as we progress through the weeks to come. Well, as we head into earnings season for the fourth quarter of 2015, companies are expected to report year-over-year declines in earnings of minus 4.7% and revenues of minus 3%. By the measure of price to earnings ratios, the 12-month forward price earnings at 16.1 remains well above the average of 10-year average of 14.2. To us, this means that stocks at current prices remain expensive by this measure. As for the other metric that we like to look at, enterprise value to earnings, the S&P 500 companies are valued at current market prices at 12.5 times. It's down slightly, but not much. Well, the 10-year average is 10.9 times. So this is much too expensive for our tastes. Margin debt, where investors and traders borrow to buy equities, is another indicator of the health of the stock market. In 2007, margin borrowing turned lower and was followed by the S&P 500 turning lower. Now margin debt turned lower in May, and that has raised some warning flags for us. Also, when the spread between large cap markets like the S&P 500 widen over the small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. As you can see from this chart, that is currently the case now, increasing the risk of a significant market correction. So another indicator that we monitor and we've been following and tells us that we should be cautious. Well, what does it all mean? Well, let's look at our themes for 2016. So we expect volatility to continue as financial market participants try to wade through all the uncertainty. What this hinges on will be what impact U.S. Federal Reserve policy has, not only on the U.S. domestic economy, but how it plays out on a global scale. China's economic growth may be the wild card here. Will commodity prices find a bottom and start to move higher? It comes down to supply and demand. Supply has been building of late and demand has not been able to keep up. If economic growth turns around, this story may change, but at the moment, it is hard to see this happening anytime soon. Will the Fed raise rates 4 times this year while other central bankers are still stimulating their economies? It is hard to see this, but that is why there is so much uncertainty at the moment. The U.S. domestic economy is the key. Will it be able to support growth, or will it get dragged down by the slow global economy and especially the Chinese economy? We have to be cognizant of rising geopolitical concerns. Will tensions in the Middle East continue to grow further? Will the UK exit from the European Union? And we can't forget Greece either. So the euro area is a major question mark in the geopolitical situation. Well, bond markets will continue to give us insight to what to expect from other asset markets, so we always will keep an eye on those. But until there is a reasonable correction, equity markets do not represent value to us at current levels. Until economic growth can return to drive revenues and earnings, inflation and inflation higher, so do interest rates, and so will interest rates globally. We will remain in a low return environment. Remember, we had almost 6 years of above average returns until last year. So while we are closer to the long-term averages, it may be a while before we can get back to better rates of growth. We'll keep that in mind as we move forward. Well, our discipline, as we often refer to it, and as I've mentioned many times, is at all times to protect our clients' capital, and especially so when we see the warning signs of potential problems. We're not alone in this thinking. Cash and cash equivalents are important defensive assets. We cannot stress this enough, as I do week after week. So we are carrying greater than normal cash balances in our models and waiting for asset prices to get more reasonable before we commit capital for the long term. Well, what's up for next week? On Thursday, that's this week, for the next week. Thursday, We'll get Euro area December consumer and business confidence, which will give us a little bit of an insight as to how the economic situation is progressing in the Euro area. Also on Thursday, we'll get the Chinese balance of trade. What financial market participants will be watching for there will be the import and export data. On Friday, of course, the always widely watched U.S. employment situation report for December. At the same time, we'll also get the Canadian Labour Force Survey, and that will give us some insights into what's going on in the Canadian employment situation. Not too much, though, for the first part of next week, so we'll obviously be back next Tuesday to update you on how things have progressed over the course of this week. But that is it for today's discussion. So if anyone who is listening might have a question, please feel free to ask it now. Too early in the new year, I guess, for questions from the listeners, but if you do have questions and wish to email us, we would be more than happy to get for you to send them. We also would love to get feedback on our webinars, what you think is good, what you think is not, and what you might like to see us cover on these calls. We always appreciate any feedback, and it's very helpful. But that's it for us today. Thanks for taking the time to tune in. We here at HIROC wish you a great week and a great weekend, and we look forward to you visiting with us next week. This is Scott Tomlinson, and I am signing off.